Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, March 29th, 2021. What we'll do in this video is take a look at the indexes. There's a few new charts or different charts I want to show you now. A couple of the sectors, we'll talk on quickly financials and what's going on there. I want to talk on the Chinese market, a couple ETFs that support there. Let's see here, we'll hit on time permitting, lumber, crude, natural gas, soybeans, and lean hogs. I think that should probably cover it. Maybe hit on gold and the volatility indexes. But if I do, we'll do the volatility indexes with the broad markets right after the broad market. So we'll go through in roughly that order. Start out here with the S&P 500. So this is the story on the S&P 500. I've looked at this trend line many ways, many times, and I still think this is the best fit. So I'm still going off the fact that the S&P 500 broke down here, gave us a sell signal, went on for a snapback rally, which put in a marginal new high and simply extended the existing divergences. So that's where we're at. And should we make another marginal new high, which is certainly possible based on those 60-minute divergences that just got put in on the futures, that would still still very much keep those divergences intact. You can see what I'm talking about here. The indicators are lagging very clearly behind price, with price making higher highs, and that is negative divergence right there. Again, take a look at this. It's a big move. It's very large. Again, this was when the Fed came in with the nuclear options here, or nuclear response to the COVID crisis, and has kept the pedal to the metal. So it's been one heck of a rally. But if you look at it, I want you to look at the top leading up to the big drop back then, and just while we're talking about its technicals here. So I'm going to zoom in and show you that pattern looked very similar to this one here. You take a look at this, we'll move away. When you take out that big move, now what you're looking at here is an almost identical setup. You had a move off the lows right there. You had a well-defined trend line which was broken, giving you a sell signal here. We went on to back test, continued to back test the trend line. All the while, the divergences started at this point. I have an indicator cut off a little right there. There's the divergences started about right here. If I can draw that, add a trend line right there. 1 second. There we go. That's where they started. We had about equal highs there on the PPO. Divergences continued, and then finally we started rolling over right there. So again, that was back leading into the highs in 2000. This was February right there, and then the big drop came. And when you look at where we're at today, almost an identical type technical setup. So we'll see if things play out that way. I mean, again, that's what to me technical analysis is all about. Keep it simple. Don't overthink things. The simple view is, these are, technical analysis is the study of charts, looking at chart patterns and developments in the charts that in the past have led to certain outcomes. So those are things such as divergent lows, divergent highs, bullish chart pattern breakouts, formations first and a pattern breakout, things like pullbacks to key moving averages that usually provide the buyer step in, such as these 200-day simple and exponential moving averages. We hit it again there. And so again, that would be a likely target, a minimum target, since we haven't hit that in quite a while. You can see again, you can have it here, here, here. You go back in time and see those same things. So again, this is what TA is all about. Every now and then you come back in and you check those key moving averages like you did here during this bullish trend. And we've been in a bullish trend here, and it's been quite a while. So if and when these divergences play out for a decent correction, that's when that's a likely target down there on the S&P 500. I want to show you a chart I haven't in a while. Well, I actually take that back. I have. I've showed you RSP, which is the equal weighted S&P 500 index fund right there, and you can also do SPEW. Depending on your charting platform, the S&P 500 equal weighted index. So right now, this is a trend line that I think is probably going to have a lot of significance. You can see again, going back to the big drop into the February of 2020 highs right here. Let me try to move this back. You can see we had a well-defined uptrend line that was not violated. Remember, on the S&P 500 I showed you just like now, we first had a breakdown, then a back test. However, the equal weighted had a nice clean trend line, nice distinct reactions along the way, one, two, three, several there, another one, and then boom, a very clear sell signal, a solid red candle and solid close below, followed by additional red candles. Everything you want to see for a breakdown. And of course, it came on the heels of the divergent high. You started building negative divergence there, had it into the February highs, and boom. So that was the technical catalyst for the drop. The fundamental catalyst obviously was COVID, and starting, shutdowns started to kick in later on. But again, so very similar setup. I'm going to jump back there, and a very well-defined trend line. So I'd suggest watching this one, because I would say put good odds that when we finally get a breakdown here. Remember, we've had the breakdown in the S&P 500, we've had it in the NASDAQ 100, but the equal weighted S&P 500, because some of the sectors, there's been some sector rotation there that's kept the market moving, even as tech has broken down and remains well below the highs. So this is one that I think will matter. And if you can always track RSP, it's an ETF that tracks the equal weighted S&P 500. So you can see, again, very clean uptrend line right there. And so I'll be watching this. In fact, let me set a sell signal here, an alert, just to get a heads up if and when that goes. And I can see the divergences. So that's that. QQQ, as I've talked about, the NASDAQ 100. Kind of a busiest chart here. Let me go back to it. The key points are, this is our primary uptrend line, nice and clean, a lot of reactions, broke down, and we're still well below the trend line right there. So only time will tell if that was it, that 12% or so drop, or if this was the first leg down with a snapback rally and more downside to come, which I am still leaning towards because of everything I've talked about in recent weeks and months, including sentiment extremes and the technical posture of the charts and everything else. It's been, give the market points, it's been very resilient following the breakdowns on the S&P 500 and NASDAQ 100. Again, this has been mostly a tech correction for the most part. So, but again, levels to watch. As I've, not much of an update since last week. I did want to show you those equal weighted indexes, and I'll get to the QQQ equal weighted. But still, same story as I was covering last week. We need to take out 310 to open the door for the next wave of selling. A break of 310, a solid break and close. Remember, this is a daily chart, so you'll need to see a candlestick close. Will increase the odds. We come back down to that 297 target, which was already hit once, and the fact it was already hit once. If we do get close to that level, I suspect it will go. And again, my next target's 283. And probably bounce there and then close the week back on or above those 200-day moving averages. We'll see. First things first, and if it goes the other way, this has been a multi-month trading range. We had a couple days we broke down, hit my first 297 target there, snapped back up in it, but look at all these candles within that range from about 340, we'll call it 325 down to about 310. And so that's the same story. Not much to update there. Bullish upside break, bearish downside break. Okay, so just like the S&P 500, you have an equal weighted index for the NASDAQ 100. You can either type in NDXE, or again, depending on your charting program you're using, that's the equal weighted NASDAQ 100 equal weighted index. There's your trend line. And that one has broken down. You did have the divergence at the high and everything else, that confirmed that, or indicates to me that it's most likely this breakdown is a start of a larger correction with more downside to come. And I haven't updated this chart quite some time, but I could tell you right there that is a golden target, about 55.70. It'd be comparable with that target I give you on QQQ, and you can see it also comes in right with the 200-day simple and exponential moving averages. And so I suspect we'll be there soon, within the probably next few weeks, and that's about another 10% drop. We can also look at QQQE, same thing. If you wanted, this is tradable. You can't trade an index. You can't buy the S&P 500. You can buy futures on the S&P 500. You can buy options. You can buy ETFs, mutual funds, but you can't buy the S&P 500. So you have to use a proxy. In this case, for the NASDAQ 100, you either buy the Qs or you can buy QQQE, which is equal weighted, and it's telling me the same story. I mean, the breakdown is unmistakable, as was the divergent high and where we're at now. So we just need to get a breakdown, and that'd be your target on QQQE. It's about 68.68 right there. Nice level, and comes in also with the 200 days. One more I want to show you too, I haven't in a while, is the NASDAQ composite. Remember, before the NASDAQ 100, really there was a NASDAQ composite. And the NASDAQ 100 are just the largest 100, the top 100 companies by market cap in the NASDAQ. And so this is the NASDAQ composite. It consists of thousands of stocks, and same thing. It's clearly broken down. There was your divergent high. There was your first leg down. It's probably a second wave down. And there's a trend line that needs to be taken out, and there's your target for the NASDAQ composite. That's about 120.95 or so, 120.96, somewhere in there. And that is also, it should be roughly 10%. Let me just measure it for you. About 8% on the NASDAQ composite. So that would indicate, if my numbers are right, we're probably going to drop more on the NASDAQ 100. And what that's going to do is you're going to have probably the biggest selling pressure in those market-leading FANG stocks that make up the top, the bulk of the returns of the NASDAQ 100. That's the difference. You have that high, very heavy weighting on Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, and they put the biggest pressure on the NASDAQ 100. And small caps, IWM. IWM so far as the last week reversed just shy of my targets. As I said, I still think that target will probably be hit. Sometimes you come close enough and that's it. Again, we came very close. You look at that, the bottom of that candle right there within, what is that? Not even, where's the percentage mark? I can't even get a number here. Let's try to grab the bottom of that candle, measure down to, if we had an exact tag of those, if it was a combination of that 205 price level and the trend line, we came within 1.4%. So you could say close enough, and sometimes that's all it gets, but I suspect we'll hit it. Again, to me, it was a magnet, and I think that magnet will pull prices down, and we'll get another thrust down, and probably undercut the trend line, hit the 205 level, and then park back on the trend line, just similar to what I have going on with the S&P 500 or the NASDAQ 100, undercutting those 200-day moving averages, hitting the price support, bouncing. And again, it's a very micro call. Most people aren't going to give you, and it may not pan out that way, but another simple way to put it is, look, there's a support zone, and that's a target zone right there. And I'm still leaning that way. If we get it, it's going to give us a drop of about another 6% or so. So even on last week on Thursday when we came close, the risk reward starts to diminish. And the proper thing to do is the trail stops down when you start getting close to a target like that. Or it depends if you're going for a much bigger drop, because I'm still very much open to the possibility of a larger drop in IWM. That next price target or support level, not counting the moving averages or anything, is all the way down to 170. So if things were to get ugly in the coming weeks to months here, that'd be about a 22% drop. I don't want to go off on topic. Sometimes I do ramble because I'll throw in my fundamental thoughts, but I just want to say, if anything, if you're wondering what could do that, the economy is coming back online, vaccines are working, restaurants are full. The two themes you've heard me for a long time saying: inflation, inflation, inflation. And that is clearly there. It is being understated by the CPI. I have no doubt about that, and being dismissed by the Fed as a non-issue. But again, I've gone over that in videos, showed you just all types of commodities, not just agriculture commodities, industrial commodities, just about everything. But the other one is, so you have that there, the inflation risk to the stock market rally, and which of course brings rising rates. And that's one thing. If you're wondering, well, inflation, of course, that's not good. When prices on everything start going up, it puts a dent in the consumer's pocket, and that knocks down consumer spending. But the other thing too is it brings up interest rates. And while the Fed can keep short-term rates pegged at zero, forcing, in a way, one thing they're doing, and it's intentional, is to force your money into the stock market, because your bank's not going to pay you 5% or even 3% on a CD or money market right now. They're going to give you next to zero. And so therefore, the alternatives, everyone's chasing stocks, and it's worked great. And the Fed has made no they haven't had to ever tried to hide that fact. That's one of the reasons they bring rates down, is to force money into the stock market, give the wealth effect. But again, they've been doing that for a long time. We've been at near zero rates for a long time. So in the past, they pull interest rates down when a recession starts or after it started, spurs growth, gets the thing going again. Anyway, let me loop back to the second thing. So that's the inflation thing, and then again, the risk to the market being that the longer term rates, the 30-year, even the 10 and 5-year rates have been moving up, and then that sucks money out of the market when people, and especially institutions, hedge funds, pension plans, when they can start locking in safe money into high quality bonds, at 3, 4%, 5%, the higher rates go, the more it's going to siphon money out of the stock market. That has been a constant over time. And it's hard to say where exactly. It's not a flash point where it's at one level. It's gradual. The higher rates go, offering a decent return on fixed income, it's going to siphon money out of the stock market. So okay, so that's the whole inflation / rate thing. The other thing I think is supply chain disruptions. You probably heard a little bit about it over the last few days with that tanker that was lodged, stuck, blocking the Suez Canal. It's now been freed. But you probably heard about supply chain disruptions there. And I can tell you right now that is, I think, going to continue to put pressure on a lot of corporations. I can give you an example. I ordered a boat back in new boat back in November, supposed to come in February. The boat's still not here. They started to build it, but it's being held up. There are shortages across the board, and that is one industry. But I can tell you, I'm hearing it in all type of industries, including the automotive industry. And an example, sometimes it's just one or two parts. It's the engines on the boat. Right now I heard there's a shortage on resin, and several boat manufacturers, I've heard from different sources down here in Florida where I'm from, have or will soon be shutting down production because they don't have the resin to make the boats. And I can tell you on just outfitting the boat, several of the parts that I've ordered have been on back order for months and are still on back order. Trolling motor, the Garmin MFD, multifunction display, that's your depth finder, sounder, back order, back order, back order. Lithium batteries, back order. What else? Rod holders, you name it. A lot of these things are on back order. So where I'm going with this is demand has been booming with the wealth effect from the stock market and all the money, stimulus money, stimulus checks people have gotten, businesses have gotten, but that's only goes so far when demand is very high. Again, I'll use that boat industry or the automotive industry. Demand goes up, but it's great if you run a boat building company, but to have that kind of demand. But guess what? If you can't build the boats because you're missing just a few parts that are critical, and that's what's going on, it's going to start to impact those and have a ripple effect on the economy. And that's the thing. Here we are, a year past COVID. Well past the 1 year mark, and we're really just seeing those supply chain disruptions that they're not, if anything, I'm not going to say they're getting worse, but they're not getting better at this point. So that's the other risk I think is in the markets. Sorry to be Debbie Downer on that, but I do think that would be, if you're wondering again what the technical catalyst might be for a much bigger drop, I think that is those are two of the risks. Again, the inflation / a rising interest rate risk, as well as continued supply chain disruptions, which then curtail, corporate profits. Okay, let's look at a few sectors. Just follow up on some of the ones I've covered recently. XLE, energy sector ETF, big resistance at 53.61. So far, a move down. A tag of my first target at 47 and a perfect bounce. So again, it's the question of, is that it? Is that the correction? Is it going to hit my minimum target, or is that the first leg down with a bigger drop to come? Only time will tell. We'll see. Based on the scope of these divergences and everything else, I suspect there's more downside to come. So that's one sector. It's been one of the strongest sectors, and it recently has cracked. In other words, this is a common theme here. The S&P 500 has been very resilient and outperforming the NASDAQ 100 in recent months because tech broke first, but you had other sectors keeping the S&P 500 up, and I'm seeing some of those starting to crack, such as energy, such as the financials. Financials gave you that sell signal about a little over a week ago right there on that breakdown of this bearish rising wedge. First target was 32.83-ish. We hit that, or just very close to, for all intents and purposes, within basis points, a fraction of a percent, and a bounce back. And the big question is, there more? Again, look at the look of this bearish rising wedge pattern with the divergences. It would appear to me there'll be another leg down to at least my next target, which is 31.35. And if so, this is another, and especially a big sector. It's about 10-11% of the S&P 500, and that would start to put pressure on the broad market, i.e. the S&P 500. Okay, so that's all the longer term stuff where I think we're likely headed. But near term, you have to respect what happened last week, and that is we hit a lot of my price targets, or initial price targets were hit, like that 38.47.80 support level on SPY, or ES. I'm sorry, these are the futures, and we put in the first divergent lows in quite a while. And again, it's watch, rinse, repeat stuff. You see these divergent lows have been, this is the MO for the market for many, many months now. You put in these divergent lows, and that's the catalyst to the next new high in the S&P 500. And once we get that marginal new high, typically, not always, but typically it ends with divergence, negative divergence that is, and that's the catalyst for the next correction that then ends with a divergent low up to a marginal new high, divergent high, correction. We put in a divergent low last week, and we're back close to the highs. At this point, we're in spitting distance of new marginal new highs, so be surprised if we didn't get it. But you do have to respect that high. Previous reaction highs are pivot points, and traders will look at those, and that is resistance. We'll see how the charts look. Then small potential divergence forming. The other thing too, keep in mind, is this correction off this last divergent high was relatively small. You can see these were a lot bigger, and they really helped to purge out some of the excess bullishness and bring in more shorts. This one was very muted. So again, I'm putting a much higher weight on that primary trend line up on the equal weighted S&P 500. I started out in the beginning of the video. But near term, you have to, this is what's happening near term. And this is if you're trading day to day, actively trading, then this is what you want to watch, these shorter term charts. And again, that was a catalyst for the rally since last week. And it wasn't just the S&P 500 futures, it was the NASDAQ 100 futures. Same thing, put in our first divergent low, have a big level there, 1207. Lots of reactions on the 1207 level on NQ. If I didn't make mention, this is NASDAQ 100 futures NQ. Many, many reactions there. We had a slight undercut, closed back above it, and we put in a divergent low. First divergent low since right here. And I could go back, and this, every now and then I have to update these charts when the futures roll. This was a divergent low right there, and that was a catalyst for this rally up to that divergent high. So you can see, I think you can see all the DH divergent high, DL divergent low, divergent high. This was a divergent low, that was a divergent low. Oh, and okay, so that was then, that's already been covered. That was covered last week. Now I'm looking at this trend line right here. It's pretty well defined. You have, of course, it comes off the highs right there in the NASDAQ 100, and then you have enough reactions to help validate it. So this is a near-term target. It would be an aggressive yet objective level to short. I think for active traders, very, very objective. Active traders can just game a quick pullback short there, and either play a pullback 2-3% or more, maybe down to this uptrend line right there, something like that. Or take a shot and keep a tight stop and let it ride, just in case this divergent low doesn't pan out to be the catalyst to the next move up. And that's again what I'm looking for based on everything I see on the daily charts and many other things on longer term indicators and sentiment indicators, volatility indicators, things like that tell me that this time around these divergent lows may fizzle out, and if so, that's a change of character. So that was it on the NASDAQ 100, and then of course I covered it on Russell 2000. So all the indexes that I follow, the big ones, the NASDAQ 100, S&P 500, and Russell 2000, all put in that divergent low last week, and it certainly played out so far for a bounce. The small caps got checked here. I need to put a level right here. See these recent reaction highs? This is now the level to watch if you're trading the small caps. They were rejected there for the at least third time over the last week. So I'm going to put a line right there, and that's about 22.22. You can see it right there. And so here's the story. If we take that out, that's going to be bullish, open the door for more upside. But if we go much lower, look for a back test of this trend line, possibly. And we're also at the back to the bottom of my T2 zone. So this is all interesting. And again, this kind of, well, to me, if we take that out, it's going to open the door, and then I think we'll go ahead and hit that target I have on IWM. Remember, we came very close, and we pretty much came right at that previous reaction low on the Russell 2000 futures there when we reversed. But I'm still leaning towards one more leg down, and quite possibly more. I spent all day today studying, poring over hundreds of charts. If I had time, I'd love to cover them all. But I see a lot of stocks in the Russell 2000, many that have broken down, and quite a few more that haven't yet, but they're right on primary trend lines or price support levels, and could break down and would break down if the Russell goes much lower. So it can tolerate maybe a marginal new low to hit my price target on the daily, that minimum target again on the daily I just covered earlier on IWM. But if it takes that out, if it takes out that primary trend line off the March lows, then IWM is probably going much lower. And again, technicals will come first to get that breakdown. And if it happens and those next targets are hit, well, one thing I can all but guarantee you is that the news flow will start to change. The headlines will change, and they'll start to, whether those are the risks, the ones that I see, supply chain disruptions, putting an impact on corporate profits, rising interest rates, inflation, those kind of things. Those are some of the potential risks to the market. And that's probably what you'd hear more and more about again if we start to take out the support levels just below and open the door to a bigger correction. Okay, quick look at the volatility indexes. I told you I'd like to look at that as well. This is the VIX. This is the board I like to use right here. VIX has very good support around. It's not a hard. It's a pretty hard line. Around 2042 right there, and it's defined. It's been support now ever since that drop last year. This is when the market's topped right here in February. The VIX had already started to move up. That's the big plunge into the February or March lows with the shutdowns from COVID and everything else. And since then, that's where the VIX has found support, and we're still flirting with that support. I talked about it recently. We took it out slightly, but still enough that this could be a whipsaw signal, false breakdown. It is a divergent low, so you still have the positive divergences I pointed out a couple weeks ago. They're still very much in place. It would be, and that's the thing, we'll have to keep, for a perfect scenario, for this VIX to hold this support level and have this prove to be a whipsaw, ideally we'll need to see the market roll over soon. So well, take it for what it's worth. So if we take that out by a wide margin, guess what happens? Then this support level is broken. We'll probably go back to the old support. This was the support on the VIX leading up to the 2000 highs. Again, you can see how it works. VIX trades very well to the technicals. And it's not just random. Usually you get, just like you have negative divergence in the indexes, which you did. All of the major indexes had negative divergence leading up to the February highs in 2020. You had positive or bullish divergence. And then boom, you had a breakout right here, a back test of the trend line, and then off to the races. So the VIX often is like the S&P 500 in reverse. Just wanted to show you that. So that's where we're at. I don't have a very clean downtrend line. You don't always get a downtrend line, but again, if it holds support and starts to rally, what you want to see it take out these levels: 25.20, 31.25, we'll call it, and then 37.20. By the time, if you get up to 37.20, again, trust me, we're in correction mode. And if you break that, you're probably in meltdown mode. But again, first things first. Let's just see if we even hold this support. Otherwise, we're going to maybe get another thrust to new highs in the market, and that could bring the VIX all the way back down. But as of now, the VIX is still at support, and that's why you have to kind of be, on guard for a potential, drop in the market if that we start to rally impulsively off there. VXD is the Dow. Well, I don't even have that one marked up. VXN is the NASDAQ Volatility Index, also at support. That has had a floor of about 25.50 You can see since the big drop, again, let me zoom in a little bit. This was a drop into the 2020 lows, and since then, every pullback for since that point in time, over a year now, has been contained at the 2555 level. And just like the S&P 500 or the regular VIX, if you break it, next support's all the way down there at 1463. That's the bottom of the old range. And there's a couple others. There's a Russell 2000 VIX, Russell 2000 Volatility Index, same thing, on support, and that's the common theme. So that's what I wanted to hit on. Apple, this is what the Apple VIX looks like. Yes, Apple, because it's so darn big. It's the only stock I know of. There might be others, but has its own volatility index. And just like that, you want to look for these divergent lows. And they're also often the catalyst. Remember, when volatility in an index or a stock like explodes, this is going to go higher. And so there was a big correction in Apple back then, and that's when the Apple VIX exploded and put in another divergent low, big rally in the VIX, Apple VIX, which is a drop in Apple, and here we are again. So similar technical postures, positive divergence building, and it hasn't been taken out, not even close yet. Oh, and there's a downtrend line, which if taken out will most likely indicate a much bigger drop coming in Apple. But again, we're at the bottom of the wedge right there, so first things first, let's just see if we even start to move back up and get towards the top of the, towards that downtrend line. And believe it or not, even crude oil has its own VIX. This is the OVX, the crude oil volatility index, and you can see support here, especially since that big meltdown. And that ended with a divergent high when oil bottomed back in looks like April or so, and since then every pullback in the oil VIX has come back to this 3087 level, and we're starting to move higher now. So there's a pretty big decent resistance level about 7050 that if that breaks, that means oil is probably going to be in a sharp correction mode. Otherwise, we're towards the top of there. That's resistance. You could see this pull back down to the bottom of the range, and that would indicate another leg up in oil. Okay, I'll do a couple more and we'll wrap the video up so it doesn't go too long. Since we're looking at the crude volatility index, here's crude oil futures, which I've been highlighting recently. Downtrend line to watch, which is still a potential target, just like the indexes, and not by mere coincidence. We put in a divergent low recently, right there, last week. Crude tends to move in line with the stock market quite often, as it has been lately, and so by no surprise, that's rallied back up. We hit that third target there at 57.25, reversed, and we bounced back up to that first target, and that's capped us so far. So again, since we had a divergent low there, bounced up there, we put it in again and double bottom right there, bounced up, $61 or so. That's the first target. And then if we go up, which wouldn't surprise me because it's not too far above, come up, kiss this downtrend line, that would be an objective place to short. Or if you're a bull, go long on a breakout, but I probably wouldn't, because you're going to have big resistance right there around 63.76. So again, these are the levels. Trade them as you want. If you're bearish, first objective short entry, well, is really right about here because we're at resistance 61, give or take. Second level there, it's a downtrend line, and then 63.76. If crude does much more than that, that's going to be a near-term bullish, but it could reverse any of those levels there. And the big level would be, of course, T3. We already hit it twice. That's again 57.25. A break of that would open the door to that $54 potential target down there. And then nat gas, that one has been laid out as a bullish setup recently, with the positive divergence down here, and it's been walking higher. It's not moving up very impulsively, but took out the downtrend line, back tested it, remained above this uptrend line, trying to punch through that 2216-ish level right there. And that should open the door to my next target at 2675 and then 2741. And if that gets taken out, potentially all the way up here to 292. So again, keep stops maybe below that trend line, or at the very least I still think above this 526 level. That's big support. A lot of reactions took place around there. All right, I'm going to wrap it up here. There were some other securities I'll get to later in a separate video. I want to do update on soybeans. I'm still bearish. I think there's a potential there. HE, lean hogs. I think that's set up for a nice reversal drop. Cover treasuries in the next update, gold, and I think that's about it. All right, let's get this out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.